Let's talk about your different mortgage options. You're pre-approved, you found a home, you're in the final approval stage, and it's time to select that mortgage product that you're most comfortable with and will meet your financial goals for this property. There's really two main types of loans in the marketplace today. There's fixed rate mortgages and there's adjustable rate mortgages, often referred to as the ARM. The fixed rate mortgage is the bread and butter, classic cookie cutter type mortgage. There's really not a lot to explain here other than that the loan is fixed for a term that you select. It can be 10, 15, 20, or 30 years, and the payment is amortized over that term. Amortization just means that you're paying a little bit of interest and principal with each payment. The longer the term, the more interest you'll pay, but the shorter the term, the higher the payment. So it's, if you'd like to pay less interest, you can take it the shortest term possible, but again, you just got to make sure that you can qualify and handle that payment. Fixed rate mortgages represent the lowest risk in the marketplace, and for the last, since the mortgage crisis in 2006 and 7 have really represented the large portion of what we of loans that we do. Now that being said, there are adjustable rate mortgages out there that are popular among many consumers because the interest rates tend to be lower than fixed rate mortgages. The reason why adjustable rate mortgages have lower rates is because the lender is transferring risk, the interest rate risk, to you as opposed to taking it themselves. Lenders that do fixed rate mortgages, especially in a low interest rate environment, have a lot of risk because they're going to be holding a portfolio of loans at really low interest rates, which will be below what interest rates might be in the future, which would mean that they'll have a hard time selling any of those loans because they'll be at such low rates. So in order to try and transfer this rate risk to the consumer, they entice you with lower rates. So for example, on a 3-1 ARM will typically be the lowest rate you'll find on an adjustable rate mortgage, and it might be somewhere to 2 to 2.5% lower than what a 30-year fixed rate would be at. ARMs can be beneficial if you have a fixed or if you understand exactly what your timeline is going to be in the property that you're looking to purchase. So if you know this is a short-term housing play for you, then you can pick an adjustable rate mortgage that you can fit that time period in, and you will be able to save yourself some interest expense over that time. The big risk that you have in an adjustable rate mortgage is when it adjusts. Now, it's important to talk about the fixed rate ARM, which is a fixed period ARM, and that is almost 95% of all the ARMs in the market are fixed period ARMs, and that's a 3-1, a 5-1, a 7-1, and a 10-1. And just the number in front of the 1 refers to the number of years that the ARM is fixed. So a 5-1 ARM is fixed for 5 years at that start rate. After the 5 years is up and in the 6th year, your loan will adjust to the index the ARM is tied to and the margin associated with the loan. Most ARMs are tied to the LIBOR index, and they tend to have a margin anywhere between 2.25% to 2.5%. So, for example, someone who had gotten an ARM 5 years ago and their ARM adjusted recently, they would have an adjustable rate mortgage rate today of about 3%, and some people even in the 2s. Now that's because we're in an extremely low interest rate environment. As things would go up, and if the LIBOR index was to go to 5%, then their interest rate would climb to almost 7.5%. So there could be a lot of fluctuations there. And in many cases, and as the case with our customers, if you do choose a fixed rate mortgage, you just want to really know when your fixed rate period is up and contact your mortgage advisor before that so you can look at your options before your loan moves into an adjustable rate mortgage on an annual basis, and you can understand what type of payment shock or changes you might be in for.